European markets had a disappointing session yesterday, slipping back sharply on a combination of fresh uncertainty over trade talks between the US and China, rising concern as to what sort of Italian government we might get, and disappointing economic data from INS fell to their lowest levels in over a year. This would appear to suggest that the slowdown that we saw across Europe may well be showing signs of spilling over into Q2 and may be symptomatic of a broader economic malaise. While U.S. yields slipped back on safe haven buying of U.S. Treasuries, bonds got battered again, sending yields to their highest level since 2015, up at 2.45%. U.S. stocks also fell back initially before stabilizing and reversing their losses to close higher after the latest showed that Fed officials, while hinting that a rise was coming next month, might be prepared to allow inflation a modest overshoot of target before becoming too concerned. This interpretation appeared to lessen expectations that the Fed would be overly aggressive when it came to pushing rates higher this year, as markets dialed back expectations of 4 this year, to a maximum of 3. Asia markets weren't able to pick up this positive cue due to an announcement by President Trump that an investigation would be started into U.S. auto imports to determine their effects in U.S. national security. This had the effect of knocking the valuations of Japanese and Korean automakers and could well have a similar effect in German and French automakers when Europe opens this morning. As UK continues to slip from its peaks at the beginning of this year, falling to a one-year low of 2.4% in April, sending the pound to its lowest level this year against the US dollar, attention now turns back to the health of the UK consumer, with the latest numbers for April later this morning. With now rising faster than inflation, the hope is that the slowdown and spending pinch seen in Q1 proves to be transitory in nature, with hopes of a recovery in Q2 after a sharp fall of 0.5% in retail sales in March. Some of the March slowdown is undoubtedly down to the cold weather, as when fuel sales were included we saw a 1.2% decline, not altogether surprising when most of the country ground to a halt. Today's April retail sales numbers should see a strong rebound from the March underperformance, with a gain of 0.9% expected including fuel, and a gain of 0.5% without fuel sales. Early indications also point to a fairly decent performance in May if yesterday's reported sales numbers are any indication. While wages are now rising faster than inflation, there is a concern that the recent rise in fuel prices, along with increases in some tax rates, may impact on consumer spending in the coming months. This pinch may well start to show up in these retail spending numbers as the summer progresses. As such, the prospect of a UK this year is slowly diminishing, with a June or August window slowly closing. If we don't get a move by August, it's unlikely we'll get one at all, given that Ian McCafferty will be leaving the MPC at the end of that month. Continues to slide back, falling below the December lows at 1.1710 as we look to head towards the 1.1600 area. We would need to see a pullback overcome the 1.1780 area to stabilize and argue for a return to the 1.1920 level. Another new low this year at 1.3305, and the pound continues to show no signs of stabilizing, with the potential to fall back towards 1.3110 trend line support from the January 2017 lows. The 1.3390 level is now likely to act as resistance in the short term, with resistance behind that at the 1.3500 area. While above the 0.8710 area, we need to push back through the 0.8800 level to look at a retest of the 0.8845 level and the 200-day MA at 0.8870. A failure to do so keeps the onus on the risk of a return towards the 0.8690 level, and even the recent low is at 0.8640. Still range trading. Yesterday's slide below the 110.70 area saw the US dollar slip back below the 200-day MA before rebounding from the 109.55 area. A move back below these lows would undermine the current bullish scenario and suggest a return to the 108.70 area. We need to see a recovery through the 110.80 area to keep upside momentum towards 112.00 intact. Is expected to open 7 points lower at 7,788, is expected to open 5 points lower at 12,971, is expected to open 2 points lower at 5,563. Disclaimer: CMC Markets is an execution-only provider. The material, whether or not it states any opinions, is for general information purposes only, and does not take into account your personal circumstances or objectives. Nothing in this material is, or should be considered to be, financial, investment or other advice on which reliance should be placed. No opinion given in the material constitutes a recommendation by CMC Markets or the author that any particular investment, security, transaction or investment strategy is suitable for any specific person. Original post.